Welcome to Sovereign Finance, the show that connects the dots between personal finance, global finance trends, and deep human history. Tune in every week to demystify the money puzzle and protect your interests in a turbulent world. Welcome to the Sovereign Finance Podcast. I'm your host, Rob Drummond, here with Derek Dearden. How's it going, Derek?
It's good, thanks, Rob.
On our topic today is pension plans, how they're supposed to work and why they don't. And I wondered where we needed to start with this mess of a topic.
Right, okay, so historically, the majority of people had pension plans that were arranged by their employers. And obviously, there were a few sort of small independent professionals, solicitors and accountants and so forth, and they'd make their own arrangements. But whichever way round it was, the idea obviously is to provide for an income when you are no longer able to work or no longer wish to work, that is adequate to support a lifestyle that is more or less in line with what you had when you were active. And the occupational schemes were generally designed to provide you with an income of 2/3 of your final salary when you reach the point of retirement. The idea being that you wouldn't need quite as much as you had throughout your working life, because you'd have probably finished the expenses of bringing up your children and getting them educated. You'd have made your major investments in housing and so forth, and you might have a bit of spare savings and investment by then anyway. And for a long time, this was entirely functional. From when these schemes started in the middle of the 19th century up until about the 80s, when they started to persuade people to change the way the arrangements were done. Now, the way they work is that over the course of your working life, regular payments were made into a fund. It was called by various names, a retirement account or superannuation or what have you. And sometimes this was entirely contributed by the worker, and other times there would be a portion which the employer put in. I think that was probably the more usual way. And either way, the individual didn't really notice it because it came out of his pay packet and was kind of more or less invisible to him and done behind the scenes. But so there was a period of accumulation and then a period of distribution. And the idea was that at the moment of retirement, that what had ever been accumulated in the retirement account went into was used to purchase what they call an annuity. And an annuity is like a, if you like a life insurance policy the other way around. Instead of paying regular premiums as you would with a life insurance policy, and then your survivors getting a payout in a lump sum if something happens and you die prematurely. The idea is that you pay it's usually a life insurance company that arrange these things. You pay them a lump sum, and you get a weekly or monthly or quarterly or yearly payout for as long as you're still alive, and then it stops. And this is worked out on the statistical basis. They don't know how long you're going to survive after retirement, or even if you're actually going to get there. But by the law of averages, they can work with the statistics of the various lengths of time that people people survive into various ages, and work it out so that there's enough to cover them on average from the capital that's been accumulated. And the point about this is that if one did it another way, you accumulated a fund over the course of your lifetime, you could buy a safe investment and simply live on the income for that indefinitely, however long you did survive, and then that would go into your estate and be able to be left to your heirs. But it's done by means of an annuity, because that way you can have a larger income than you would simply drawing the interest on the capital. For instance, throughout most of the 19th century and into the early 20th century, British government British government bonds were regarded as an absolutely rock solid safe investment. There was no doubt that the British Empire was going to be there forever, um, and there was no doubt that the value of sterling would hold up forever. Of course, it didn't work out like that, but that was it. And because of that, the British government could actually issue undated bonds, which meant they never actually expired. The thinking being that anybody who held those bonds and didn't want to hold them any longer, they didn't need to wait for the thing to expire and the government to give them their capital back. They could simply sell it to somebody else who would be happy to take it on and get the income from that bond. And so they were typically about 2.5%. And so if you had £100,000 in your retirement account, you'd expect to get £2,500 annual income from it indefinitely if you just used it to buy government bonds. But by buying an annuity, the insurance company could buy the bonds. They could realise that they're going to get that capital back when the annuity expires on your death, and therefore they might be able to pay you £4,000 or £4,500 a year instead. Now that's broadly the structure that still exists, except that for one thing, we have inflation as a fact of life now. So for one thing, whatever income you get when you retire, if you live for another 10 years or 15 years or 20 years, if that income stays the same, it's not going to provide you with nearly the same purchasing power. The other thing is that the kind of levels of contributions that people made were enough with the return they were getting on them to accumulate a significant amount. And of course, the other thing that has changed is that the return on so-called safe investments, government bonds, has fluctuated wildly in recent years. And in real terms, particularly if you take a real measure of inflation rather than trusting the somewhat dubious figures for it put out by the government, it looks even worse than it might. So I think that there was a general understanding within the finance industry in the 1980s that the arithmetic was not going to hold up so beneficially for the general population on that, and that was certainly either prescient or intentional. And because of that, a lot of people were for one thing, a lot of people were persuaded to take on personal pensions rather than relying on employer schemes. And a lot of employers stopped offering these schemes and stopped offering the guaranteed level of income. and even so, a large number of those funds are now in deficit. Is there anything you want to say about that? Ask for any points of clarification there?
I was just thinking about the difference between my dad's generation and my generation. So my dad worked for Unilever his entire working life, and I forget the details now, but he did retire with a reasonable pension. That, as you say, was a certain amount of his final salary, and that to me feels like an alien world
Yes.
to what I'm operating in. I have one pension that was from that was an employer scheme that I basically said yes to just because they were paying into it as well. So I thought, well, they can pay into it as well. When I'm 55, I can take a tax-free allowance and go on holiday with it or
Yeah.
something. That's basically the extent of my plans for it. So I need some other way of like funding my retirement, basically that I need to
Yeah.
work out. And I think a lot of people my age is 20 to 40ish are probably in a similar boat.
So that is absolutely the case, and it was quite interesting because I remember when they brought these schemes in, and you know a whole lot of so-called financial advisors cropped up and acted as intermediaries to sell these schemes to people and presented various projections of how it was going. And certainly when I put out my pension scheme, I've still got the letter somewhere from the so-called advisor, and he was assuming that the money that went into the fund was going to compound at 16% a year, and he even actually said that this was a conservative estimate. So, according to his projections, one of the things that was ridiculous about them is that they were calculated down to the penny as to the size of the lump sum I'd get and the annual income, whereas obviously that's a completely spurious level of accuracy.
Yeah.
But when it actually, by the time in retirement actually arrived, well, not that I'm really retired, I can't afford to, but by the time it came to take my lump sum and my annual payment from the rest of it, it turned out that the returns were something like around 10% of what had been projected when I took the plan out. And
So there was some way off.
they were some way off, yeah. And there are various reasons for this. Over the course of the the accumulation period, the money is invested usually in a mixture of stocks and bonds. Stocks are part ownership of the corporations, and bonds are essentially loans to the corporation or loans to the government, which receive interest. And the there's generally a higher return in real terms on equity shares than there is on bonds, or certainly a potential to make higher returns if they're well chosen. And over the years, the real returns have been a lot lower than they were historically. And this is partly due to inflation, partly due to the fact that the official figures of it for inflation are grossly understated. And it's also partly due to the amount of to the amount which is being skimmed off at every level of the operation.
There's a transaction fee every time that if you've got an amount of money that's been invested in a pension fund and that's being invested into various stocks and various bonds, there's a fee every time that happens, surely.
Exactly. Well, the people managing the fund, they have to pay a fee to the stockbroker every time they buy something or sell something. They draw their own management fees for doing whatever it is that they're doing with it. The the advisor, or one might call them more honestly, the salesman who introduced you to the fund and persuaded you to buy it, will get a commission. Uh, One thing that was really shocking when I found it out is that there's a so-called management fee, which is so much a year, and a lump sum at the beginning. And I think this is still the case. It certainly was both at the time that I did that and also at the time that I signed up, advised by the same individual for a combined savings and insurance scheme. Uh, and at the end of the first year, you find that your entire year's contributions have gone to pay the fee or commission or whatever it's called uh, to the salesman or the advisor.
I used to know an independent financial advisor, and he called this the goo of the financial system.
Mm-hmm.
So you think you're going to put in X and get out Y, but actually there's all this goo in the middle that just absorbs a lot of what you're putting in somehow.
So these are directly concerned with and it's worth bearing in mind that the whole, in order for this to work at all, it depends very much on compound interest, on the fact that during the accumulation period, all of the money that you put in goes into some investment which is providing a return, and the returns on those investments are themselves reinvested in the fund. So that accumulates. And as I think we have discussed in the past, and we'll probably do more detail uh, in a topic specifically on that, the way that compounding works is drastically affected by uh, quite small changes in the interest or the dividends that are paid. I mean, for instance, if take a simple example, if something is providing a return of 3.5%, it will take 20 years to double. Uh, Whereas if it's if it's providing a return of 5%, it will only take about 16 years to double. 15, 14 years to double, in fact. So that relatively small difference in the percentage return makes a great deal of difference to how much you will have accumulated by 40 years' time.
And the compounding can operate negatively as well. Like if you're just leaving your savings in your bank accounts with a nominal um, rate of interest, like that rate of interest is going to be below the rate of inflation.
Yeah. Yeah, I mean, bank account interest, certainly since 2008, and I think for longer than that, have been lower than even the official rates of inflation, much less the real rates of inflation. So it's been eroding rapidly. So the actual returns have not been at historical levels in real terms. And this has been further aggravated by the fact that a large amount of the gross profit of corporations, a much larger proportion is going to the remuneration of top executives in various forms than it was historically. Uh, and this is really a swindle on the owners of the company because, you know, the shareholders of the company are strictly speaking the owners, and they should be the ones who are getting the benefit of the profits of the company, either the benefits by giving them by being paid them that profit as a dividend, which was historically the whole rationale of investing in an enterprise, or by the profits of the enterprise being reinvested in the enterprise to grow its size and its capacity to earn even greater income in the future. So either way, it was supposed to go to the shareholders, whereas a large amount of it will go to as I say, the senior executives who are supposed to be employees of the owners of the company, which is you and me through our pension plans and our life insurance policies and our investment schemes, and also that the that the financial intermediaries, the investment bankers and so forth, are taking a much larger slice of that income before it gets to the shareholders. And then finally, there was the, I think, really unscrupulous thing that Gordon Brown did as almost his first action when he became Chancellor of the Exchequer after the Labour victory in, I think it was 1997. Because he'd promised not to raise taxes, and he'd also made a lot of promises about what he was going to do, he either knew full well when he made those two promises, or he found out when he actually was in the hot seat and got into office that the only way he could balance the books and not increase levels of income tax or other direct taxation was to really do it by stealth. And what he did was he removed the tax-free status of dividends paid into pension funds. Prior to that, if a company provided a dividend and that was paid to a private individual shareholder, the corporation tax would have been taken out of it. Whereas if it were prior to that, if it had been paid into a pension fund, it would be free of corporation tax, and that's highly significant because that might well have made the difference between it being 3.5% and being 5%, which over the lifetime of a pension plan would make an enormous difference to the amount of the size of the fund when it came to be transferred over to the distribution phase, and it was already clear that by that time that the pension funds were probably underfunded for what they were committed to giving out or what they were projected to be giving out. So the result of all these things is that there just hasn't been the amount there. At the moment, corporate funds are still paying out those that were entered into at a time when there was a final salary arrangement. But many of those funds are really, if you look at the arithmetic of it, in enormous balance, and they're just going to run out at some point or another. So that broadly is the situation. Is there anything you want to say about where we go from there, or what the options are?
I wanted to ask about what are the options of people, perhaps considering people at different levels of income and stages in life. So, for instance, I used to work with a number of fairly wealthy property investors, and they generally had large pension
Yeah,
funds. They generally managed it themselves, though. They often use their pension. So, you can, for instance, you can invest in commercial property as an allowable investment within your pension. So they used it for that kind of thing, and also to keep a lot of their wealth outside of their estate.
yeah,
So if they happen to die, it's not subject to inheritance tax and things like that.
that's right.
That's obviously one group of people, but they obviously kind of knew what they were doing.
Yeah,
I think the general population don't. I think the general population is just this thing where it gets taken out of your salary,
yeah,
it's going off, you think it's going to do some good in the future, and then in the future it turns out that it was going to be worth this, but actually it's worth this, and you're in a bit of a pickle.
yeah.
What can people do to minimize that risk?
The first thing is you've probably got to earn more than most people are in the first place. Is the short answer to that. And secondly, you need to make a realistic decision about what proportion of your current income you have to pay in. I think historically they used to suggest it was 12%, which I think was more than most people would be comfortable in voluntarily doing. There are obviously enormous uncertainties about the way this is going. And unless you're bearing in mind that a lot of people are finding it hard to balance the books from month to month, much less put stuff away for the future, I really can't see any realistic uh, way of doing that unless you're in a position where you can make a large income and look at likely scenarios of how that can be invested and what can be effective. I mean, certainly for people who are running companies and who need office or factory premises to work in, as you said, there is the possibility of running what they call a self-invested pension fund. Incidentally, if you there are still some tax advantages. At least the money that you pay in to the fund goes in free of income tax on those contributions. So it's pretty important that if you can do that, you can that if you can do that, you take advantage of those tax breaks. Uh, having said that, you probably need more financial expertise than most people have got to decide how to invest it. One of the things with those self-invested funds that I know of few people who've run companies, as I said, they need office space, they may need workshop or factory space. Ordinarily, that is a business overhead to pay that, but I know people who've had self-invested pension plans. They've invested that pension plan in uh, an office property, and then their own firm has leased that office space, and the rent that they pay, instead of going to some external landlord, goes into their pension fund, and that doesn't get taxed because it's a business expense. And by the way, this is not financial advice. This is just anecdotal, but it's a little illustration of the way that people have been able to work creatively within the system. But obviously, it's not something which is available to the average person.
For, say, the average 20 to 30-year-old,
Yeah,
what would the advice then be? Like, is it worth having a pension? Would you suggest sort of? So I used to follow the writing of Mark Ford, who was writing under the pen name of Michael Masterson, and he reckoned that every time you get paid, you should try and take some of that money, and he termed it paying yourself before you go and pay all your bills and whatnot. Like, take that money, do something else with it. So you could put that in a pension, or you could put it into Bitcoin or whatever. You
but pay yourself first is the slogan, and it's easy to misinterpret that. That doesn't mean pay yourself before you pay your creditors. It means pay your future self before you you pay your present self-indulgence, and that's certainly something that I failed to be aware of at that time of my life, and I might well have paid more attention to.
Yeah, it's something I've been thinking about because it's like even when there's months where finances are tight, I can usually put aside, like, even if it's just £20, I can put that aside, and it's the principle of doing it, I think.
Yeah, I think that is a principle. One way it was never clear to me as it's part of this same thing. It's part of what we're up to on this whole podcast to provide people with the information that is not being given to us. I mean, I had pretty well zero financial education of any sort. Um, Certainly not in school. I didn't get anything terribly useful from my parents in that area. I do remember being, I don't know, probably 7 or 8 years old and going down to the local shop, which was also a post office, um, with my sixpence pocket money, 2.5p, and saying, "What can I buy with this?" had in mind a bar of chocolate or a bag of sweets, which is what you could get for that sum of money in those days. And the man behind the counter said, "Well, you could buy a sixpenny savings stamp." Um, and I said, "Why would I do that?" And he said, "Well, you'd have it to spend later." And I thought, what's the point of spending it later? Um, uh, I want to spend it now. And of course, that was the attitude that I took into my early adulthood. And it is pretty well everybody else's attitude too, as well. I think a sort of systematic allocation of resources as you go is sensible, whichever way you cut it. But of course, you have to put it somewhere where, at the very least, it is in a form which is resistant to inflation and and ideally provides a real return, and that you make sure that you don't simply take that return out and spend it if it's significant enough to even consider that, but that you have a systematic system of reinvesting it. The underlying principle of doing that is undoubtedly sound. It's just that the mechanisms for doing it have become woefully inefficient, somewhat corrupted, and incidentally, this brings reminds me of something. I don't know if you've been looking. We're talking now on the 19th of April, 2024. I don't know if you've looked at the way that the gold price has been moving over the past month.
I've heard that it's been going up.
It's gone up remarkably. It was in in terms of pounds, it was at about 16 to 1700 pound range about a month ago. Uh, it was bumping up. There's a kind of psychological barrier with the round numbers. I mean, there's no reason why this should be, except that that's part of the mindset of people who trade. Uh, and it broke 1800 and 1850, and then 1900, and it's been over 1950 last Friday, and earlier this week it bumped up again. There's every time there's a spike, there's some profit taking at the top of that spike, and it brings it back down. But the overall trend has been upwards. And if you look at the market graphs, it's pretty clear that there is enormous volumes being dumped in terms of gold sales. Whether there's any real gold behind those nominal transactions, of course, is another matter. And so there are periodic attempts every few days to drive the price down, and as soon as it goes down and they run out of momentum with those sales, it goes straight back up, and sometimes up to a higher level. So uh, we could be well into a new phase where entirely new levels are reached. And it's important when we look at that to see the so-called gold prices as being what they are. I think it's misleading to regard uh, the price of gold as we might the price of copper or wheat or coffee or something, where you say this is going up in terms of the currency. Really, gold is above all another currency, and although it fluctuates due to activity, short-term activity in the market, it's really the benchmark of value. So the best way to look at it is as another currency. So if the price in sterling or in dollars is going up, what that really means is that against the benchmark of the value of gold, the value of sterling or dollars is going down. And I think you have to also see that in terms of the fact that there may well be a drastic shift in trust in the dollar as a global reserve currency. Some people have been living with that. Well, the dollar has been the reserve currency since 1945. Probably, really, in all honesty, since 1918. It was the more genuine benchmark from the end of the First World War than than sterling had been. But from 1945 to 1971, it was an indirect access to gold, because gold it was convertible at the rate of $35 to an ounce of gold over that period. And then when Nixon suspended the convertibility, it became a reserve currency in its own right. And I think this is really the first time in history that there has been a global reserve currency which didn't actually have any backing. And it meant that the United States could buy anything it wanted from anywhere by essentially writing itself blank checks. And it's astonishing they got away with it for so long. And as I think I mentioned in a previous podcast, it was possibly a serious own goal when they confiscated the Russian dollar reserves, both Russian government and wealthy Russian individuals. And a lot of other people must have thought, well, if they can do that to them, they might be able to do it to me. And I think that's why the moment the gold price goes down, there are buyers somewhere in the world, and it's mostly going to be in China and Russia and in various Asian countries, possibly African countries. There are people who are accumulating that because they know that over the future times, that's going to be a more reliable store of their wealth and store of their buying power than the dollars are. And of course, we are in the same boat with the dollar, but in an even worse situation.
Interesting times.
Interesting times indeed.
Takes us into the world of geopolitics, doesn't it?
It does indeed.
Yeah. I just wanted to, just before we finish off, I just wanted to bring us back to pensions and just try to get your answer from, if you were 18 and venturing out into the world of work and you're being paid enough to pay your future self some amount of money, what do you choose to do with that?
What would I do with that? I think the short answer is, and once again, I'm not a financial advisor. This is educational. Do your own due diligence, do your own research. But what I would do, since you're asking me that question, knowing what I know now, if I was at that stage of my life, and if I had this perspective on recent economic history and likely future scenarios, is I certainly would make sure that I paid my future self first on a regular basis, on a certain proportion of my salary, because obviously we all know, however much we're earning, we can always spend all of it, and we can always spend, if we had more, we could spend that too, and very often we can spend more than we are actually earning. And if we had been earning less, we could have chosen to live within that or spend more. And so the option would definitely be to put it aside and to not trust anything which is denominated in a fiat currency. So that would obviously include tangible assets, essentially, or monetary instruments, which we're mainly thinking of as gold or silver, which are not solidly tied to fiat currencies. And I would guess that is more or less common sense.
I'm inclined to agree. Yeah, interesting.
Yeah.
Well, thanks. I think this has been a good conversation. Yeah. We'll speak to everyone next time. Thanks for listening to this episode of Sovereign Finance. For more episodes, transcripts, in-depth articles, and community, please take a minute now to subscribe free at sovereignfinance.substack.com. See you next time.